Capital Creek's 3 in 10 podcast. Today is Saturday, May 31st, 2025. I am your host, Scott Slayton, strategist and partner at Capital Creek, a multifamily office in Austin, Texas. Here are 3 things we think investors need to understand this week. Number 1, the Court of International Trade ruling on the IEEPA tariffs. Number 2, the inflation indicators, the core PCE deflator, and the University of Michigan inflation expectations. And finally, number 3, the fiscal deficit and the trade deficit are inseparable and intertwined, yet policy is not coordinated on these 2 things. So let's start with number 1. The CIT rules on the validity of IEEPA tariffs. A court unanimously struck down the heart of the administration's Liberation Day tariffs, effectively saying that the administration had exceeded its authority in laying down these tariffs based on a trade deficit, fentanyl, etc. These issues were not considered to be a legitimate crisis, and IEEPA was meant to deal with a crisis environment. Importantly, how did the markets respond to this? Well, I went back and looked. On a 5-day basis, stocks actually did pretty well. They rallied on the ruling, which would be expected. The tariffs have been very disruptive, created a tremendous amount of uncertainty, were basically responsible for a very sharp 20% setback in April. And so stocks rallied, but they really didn't hold their gains. It was a decent week. It was an up 2% week. Very good month of May. Fantastic May. Best May in 20 years. Bond market also responded to IEEPA tariffs being rescinded by the court. Bond yields rose, which also makes sense, but they didn't really rise very much. And they were down on the week. Thursday and Friday, they came off. The dollar basically rallied for one day, couldn't sustain its move. And I think this makes sense because there's a temporary stay that a federal appellate court made the very next day after the CIT to allow the tariffs to continue on. So what does all this mean? I think it's just more uncertainty for the markets and economic decision makers. There's more waiting. I think it puts our trading partners in a difficult position because it looks like the administration may have lost some of its leverage, but they're looking at our system and going, how do we negotiate here? It's more waiting. There will be fewer big decisions made by major corporations. And I think it's just more noise. One of our key focuses has been on the dollar, and we noticed that it couldn't rally. It should have been able to rally on this. But I think markets view this as a temporary situation and don't really know what to do with it. Bottom line, trade noise, I think, is here to stay for all of 2025. It's going to take a long time to sort this out. This is probably going to the Supreme Court, and it may take many months for them to rule on this. And so here we are with more uncertainty caused by this ruling. I'd say at the margin, it's a good thing because it probably reduces the administration's ability to execute on the most draconian of tariffs. But there's a lot we don't know yet. So we're still in a holding pattern. Bottom line, trade is going to be noise all of this year. We just have to get used to it. We have to start to invest around it. Second point, the inflation data. All month we wait for this core PCE deflator. It is the Fed's preferred inflation measure, and therefore we think it's the most important piece of inflation data we get all month. This month, yesterday, on May 30th, we received the data for the month of May. Now, the reading was up 0.1% month over month and up 2.5% year over year, right on the screws, exactly what the economists had estimated. But most importantly here, the trend is down. It appears to me that higher for longer interest rates are working. Restrictive Fed policy is working, and we've almost got the inflation rate on the most important measure back down to the 2% target. In fact, the PCE price index, which does include food and energy, is down to 2.1% year over year, basically right on target. And we know that we've got to buy food, we've got to buy energy. So in some ways, in my opinion, the PCE price index is more important than the core. We know that tariffs are yet to come, so some have poured cold water on these good inflation data. We don't think that's the right way to approach it. We think that tariffs will come, but remember, tariffs are going to be shared by the producer, by the distributor, and by the consumer. And it's not all going to be put on the consumer. We think we'll take the under on future inflation prints after the tariffs make their way in. Yes, prices will go up, but we think they're going to go up less than most people think. Now, we segue to the University of Michigan inflation expectations that were out yesterday on May 30th. The expectations fell sharply. On a one-year basis, fell from 7.1 to 6.6, and on a 5 to 10-year basis, fell from 4.6 to 4.2. That's moving in the right direction. Consumers have been terrified by tariffs and are afraid that they're going to launch inflation much higher, like we saw in 2022. We do not expect that to be the case, and we expect expectations basis this kind of survey to begin to come down. So inflation is back to target. OPEC is adding even more barrels in July. We just saw that this morning. You're adding another 440,000 barrels in July. This is really working to lower inflation. The president is right about this. Oil goes into everything, and having low oil prices is really a disinflation, maybe the most disinflationary thing that can happen. So tariffs, in my opinion, are more of a risk to the labor market than they are to inflation. And the Fed is going to slowly figure this out. We think the Fed is likely to cut 3 times in the second half of 2025. The market thinks the Fed's going to cut twice. We think it's 3 because we think inflation is going to be more tame, closer to target. And we believe that the tariffs will work more on the labor market and more to slow down the economy than they will to be boosting inflation. Number 3, let's talk a little bit about the fiscal deficit and the trade deficit and how we see them as inseparable and intertwined. So far, the administration has been very serious about trade. Their actions have been strong, aggressive, loud, and persistent. But we see them as very unserious about budget deficits. DOGE has left town with their job maybe 20% done, in our opinion. We look at the amount that's been cut by DOGE. It's meaningful, but it's certainly nothing like the $1 trillion that we were promised. And it leads me to believe, well, that the swamp has won yet again. In fact, the swamp is undefeated. In my lifetime, even the great Ronald Reagan couldn't cut the deficit. So we have a structural problem. And that problem is that voters reward politicians that deliver money, goods, and services to them and to their area. They punish politicians that take away those goods and services and money. So the politicians have an incentive-based system. They are vote-seeking entrepreneurs. They want to be reelected. Many of them are career politicians. Thus, it is very difficult to ever cut spending. When we think about these massive deficits, $2 trillion a year and probably headed higher, we understand that they're stimulating imports. There's too many dollars chasing foreign goods. And part of this is because we're running these huge deficits. If we meaningfully cut the budget deficit, American consumers will reduce their demand for foreign goods. That's economics 101. So if we reduce the trade deficit, if we reduce the budget deficit, we'll cut the trade deficit. And one big, beautiful bill is not helpful in this regard. It adds to the budget deficit and thus the trade deficit. It's inconsistent with why many people voted for the administration in a Republican sweep. They want progress on the deficit, as long as it doesn't hurt. And we think this bill is going to struggle in the Senate because there's a core group of Republican senators led by Ron Johnson that are willing to fall on the sword on this issue. They see themselves as a last line of defense. So we think it's going to get a little chippy this summer And this is going to keep the markets on edge. All of those markets, stocks, fixed income, and the dollar. If somehow in a long shot the politicians can deliver on fiscal reform, we think they'll start to deliver on trade reform without all the collateral damage. But don't hold your breath on that one. So there it is, your 3 in 10 podcast for this week. Please check out our website at capitalpeakpartners.com to view our written work and webinars. And until next week, be careful out there.